Welcome back to this special Brains Trust that we are having with the top team of Deutsche Bank. Well, we have been speaking about how the IT sector has not done too well in the last few days, but the banking stocks have helped the index. So that question to you, Prateek, what will be your choice? Will IT be continued to be deserted, and will you prefer financials yourself?
No, we think we were actually, if you recall, at the start of last year, we were underweight on IT. But given the price correction, the underperformance of these stocks, now we think these stocks are looking particularly attractive, especially after the correction last week on the H-1B visa fears, which we think will, at best impact earnings by 2 to 3% for FY18. If you look at the stock prices right now, they're valuing these companies on the basis that you will see roughly single-digit earnings growth for the next 4 or 5 years. That is at the bare minimum which we think these companies will deliver. Maybe there are upside surprises from better cost savings, and don't forget the strong US dollar is something which is not being factored in, and the possibility of the dollar strengthening even further. Secondly, with Trump coming in, reviving corporate America, we've seen corporate capex, which has been very depressed for the last couple of years, could get a life of its own. We could see discretionary IT spending come back in a much bigger way than what the street is expecting right now. So we think some of the well-run, the large-cap IT companies, they could do pretty well, and that should be a core portfolio holding from this point onwards.
You can name names?
Unfortunately,
no, you can't. Okay, well, but more importantly, Bank Nifty, I mean, I'm a little surprised at the way in which it has supported the Nifty in the past few days when IT took a bashing. Is this just technical, or is there something in banks that attracts you?
Well, banks, I think, firstly, the way the valuations have moved up in the last few days, as well as given the impact of the demonetization move, the slower credit growth we are seeing, from a tactical perspective, we would be cautious on banks, but structurally in the long term, we would be positive versus, let's say, NBFCs. We think, the fact that you'll see lower cost of deposits, with technology kicking in, the operational costs coming down, etc., banks are poised to do better. But in the short term, we would be a little bit cautious.
Okay, so you would want it to get cheaper before you buy?
That's right.
Or you want to see 1 quarter of NPAs getting, ironed out? They've got some bit of a leeway in terms of under 1 crore loans, which perhaps is more useful for NBFCs. So therefore, you think something might come up horrible in March 31 quarter?
No, I think the NPA concern is largely in the price, especially the NPAs on the corporate side. Even and after demonetization, the SMEs and the agri NPLs are also, investors are expecting those to spike up, even if they're not recognized in the December quarter, perhaps by the March quarter. The bigger concern in the short term is the impact on credit growth, given the overall economic slowdown, the fact that you could see spreads compressing in the short term. So this is more of a tactical, 1-2 quarter phenomenon which we have to look past. But longer term, like I said, we prefer banks over NBFCs now.
Okay. What is your hierarchy in terms of sectors itself?
I think
okay, let me be more specific. Where are consumer discretionaries? Autos, for instance. And even for that matter, others, like the titans of the world. The big fear is that demonetization is going to hit the psyche of the rich consumer.
Well, we are actually, after the correction in the stock prices, as well as the fact that a lot of it has been priced in, it's already anticipated in terms of the earnings for December quarter and perhaps even for the March quarter. We are now actually turning far more positive on autos and consumer discretionaries than we were 3-6 months back, when valuations are very high. These stocks were priced to perfection, and as it turns out, demonetization unfortunately impacted earnings growth. We've seen the stocks correct quite a bit. And don't forget the impact of lower interest rates. As Rahul was alluding, interest rates have already come off with more downside going forward. That should stimulate demand as well. So we don't think, we think you will see a fairly strong recovery in FY18. Autos in particular, we think while valuations are above trend, but you also have earnings which are cyclically depressed and could bounce back very strongly in FY18. More 4 than 2.
Okay.
Yeah.
I just wanted to ask you, do you think the 7920 has held, or 7,900 on the index? Is the downside at least protected for the markets? Because you keep saying that there is a near-term negativity.
Well, if you look at what's happened in the last few months also, as Ravneet was alluding to earlier, we've seen significant EM outflows, but India has not seen the absolute level of the index go down that much. And one of the reasons for that is very strong domestic inflows. Even in the month of December, we've seen about 10,000 crores worth of domestic equity inflows. This, in our view, is a secular trend given the relatively poor investment alternatives, real estate, gold, even fixed income at these interest rate levels. The upside is not as much. So therefore, equities, we think, will continue to attract more flows. That should keep the market supported. That's one. And second, the lower interest rate should also help equity valuations. When you look at, you discount the earnings back, the valuations also get supported. So we think not that much downside unless something major happens globally.
Therefore, what is the upside for equities? Give me a Sensex or a Nifty level, or even an earnings growth, a return growth for the current year.
Well, we do see earnings growth. We're expecting a very sharp rebound because FY17 earnings have been depressed. 18 goes up, so 18 we could expect almost 20% earnings growth. But the returns will be a little bit lower. We expect roughly about a 10% upside at the index level, mainly because a lot of it is priced in, and it's really you have to play sector by sector, stock by stock.
All right, so sharp growth in earnings of 16-18% in FY18. Ravneet, therefore, what are okay, one pump priming factor will be the lower rates that you all are expecting. Yeah. What are you expecting from the budget?
So I think what the budget really needs to address, effectively speaking, is somehow reviving the entire investment cycle. It's been there for a long time. Initially we thought it'll take 6 months, 9 months. I still don't see any private sector capex happening over the next 4 quarters at least. Still a lot of leverage, still a lot of overcapacity. So which means that the investment has to really come from government spending. And to that extent, if you look at sectors like roads, you look at railways, defense, power, I would definitely like to see a lot more happening over there in terms of government spending. Equally, I think, if you look at it from the point of view of things like affordable housing, I think the Prime Minister talked about it, very briefly in his 31st December address. I think you'll see a lot happening on that side.
Okay. Let me put it this way, and this is a favorite question we have with all our top experts. If I were FM,
yes,
what would you do? I want you to start that sentence that way.
So I think, very often we've said that a higher fiscal deficit is looked down upon, and, to that extent we need to rein it in, very aggressively. At the end of the day, whether it's analysts, whether it's the rating agencies, they look at the quality of spending. So if it's going towards consumption, it's going towards subsidies, they look at it a little negatively. But if it's going towards infrastructure, it's going into capex, I think there is a little bit of, positivity around it, and it in no way will impact India's, credit rating. So if I was the FM at this point in time, I would take a slightly more aggressive bet and go out there and spend aggressively as part of this budget. And I do hope that you will see more government spending in this particular budget, okay, as well as, I think, tax reforms.
Okay, tax reforms would mean corporate, personal, where are you? I mean, what kind? Both?
Maybe it sounds a little self-serving. I think more personal than corporates okay, at this point in time. But I think, if you look at it, one of the main reasons for demonetization was that you want to, make sure that the unaccounted economy contracts a lot. I think to some extent that, a purpose has been fulfilled. Equally then, on the other side, which is the more official, the above board kind of economy, you need to reward that as well. And I think that the government will take a very balanced, calibrated view in that regard.
Okay. Well, Rahul, final question to you. Yeah. Your theory has been that there will be, there could be some aggressive rate cuts. Yeah. But there are two things that the world is telling us. One, this, the rocketing of the dollar, of the dollar index, even if it has left the rupee unscathed so far, that could be something which the RBI will have to watch out for. Sure. And Fed hikes. Yeah. How will these two play out on bond markets in particular and the RBI in general?
So our view, if we just sort of compare it vis-a-vis the currency itself, just starting from there, we believe that there is some amount of depreciation that sort of will step in, and that's something that we are factoring in the rate sort of cut that we have mentioned. We think the rupee depreciation would sort of trend in terms of our projections closer to a 72.5 number, with 70 becoming sort of the more normal. So there is some amount of, obviously for export competitiveness as well in our, export oiling companies, we need to have some, revenue uptake from that. So we think there is some of these things that are factored. But our domestic economy, the fact that, to the point that both Prateek and Ravneet mentioned, you need to revive, the growth. and the growth has to be revived by giving more money either directly or by way of sort of rate cuts. So I think the government will have to take that potential, view in mind, and keeping the fact that their 1% real interest rate, target could be achieved by achieving these rate cuts still.
Okay, then let me put you in a spot. Since there is a big monetary push to consumption that is expected, and a big fiscal push, again, probably tilted towards consumption that is expected, your top sectors?
Well, like I said, you have to play them you can't take a macro view in my view this time around, because you look at which sectors are cheap, where valuations have come off and become very attractive. That would be IT services, for example. If you want to play consumption, we think autos and consumer discretionary. If the other way is also the infrastructure push we're expecting, there we think the best way to play that sector is to cement. Now, cement, obviously, this year you will see a very sharp slowdown in demand. We expect cement industry demand to be down to as low as 1% for FY17. But for FY18, you could see demand rebound to 7%, especially if, let's say, there's a push on affordable housing. So cement is one sector we think stands out as something which we should play. Going back on the valuation plays, the other sector which stands out is oil marketing companies, the power and gas utilities. There we think, especially the OMCs, these are still stocks which trade in single-digit Ps, high 20% plus ROEs. We think the street is still underestimating the kind of earnings growth we'll see at these companies. So that's another sector we like.
All right, that's a lot of positivity, definitely, that we've got from the Deutsche Bank team. Key takeaways, a giant 2 to 3 rate cuts from the Reserve Bank to give a monetary push. So money to be made in bonds as well. FIIs will not desert India for long. That's one big call that the Deutsche Bank team believes in. But the FM should not worry about fiscal deficit. A big fiscal push as well to consumption and to infrastructure and to investment is what they're expecting. And across the board, positivity in equities. After a brief, perhaps, lull in the markets, even there, Prateek expects the downside to be protected, but positive on IT, positive on cement, positive on OMCs, autos, generally the consumption story, as well as a bit of investment as well. Thank you very much for joining us, Ravneet, Rahul, and Prateek.
Thank you. Pleasure.